Okay, in the last video, we spoke about and we went through the accounting for a short-term bank loan that is interest-bearing. I thought I would demonstrate the difference when it's non-interest-bearing. So when it's non-interest-bearing, that means that the bank will simply hold back the interest at the time of the loan. So on October 1, 2023, Schaefer Tool & Die borrowed $100,000 and issued a 9-month promissory note, just like in the last case. But interest was discounted at issuance at a 12% discount rate. Okay, so in this case, what we're going to take home from the bank is $91,000. So that's the debit to cash, increasing the assets. We're going to also increase a contra liability account by $9,000, and that's called discount on note payable. You'll see how this is used later. And then we have a short-term note payable of $100,000. So at this point in time, the net note payable is $91,000, the amount of cash we got. It's the net of the total note payable that we'll pay in 9 months, less the discount on the note payable, the contra liability. As before, our annual fiscal year ends December 31, 2023, so we have to prepare financial statements. Among the entities we're preparing financial statements for is now the bank that's going to require financial statements so they can review our ongoing ability to pay them back in 6 months at this point. And so at December 31, 2023, we accrue interest payable of $3,000 and accrue interest expense of $3,000. And then we come to the date that the bank note matures. And at that point, we pay the bank the $100,000 we owe. Remember, we only borrowed $91,000. We only got $91,000 cash from them, but we're paying back $100,000, and that's the $9,000 of interest. So therefore, we can zero out the contra liability discount on notes payable. We can zero out the note payable itself by virtue of a debit. And then we zero out the interest payable because we have now paid it. And we record interest expense in 2024 for 6 months, or $6,000. Now, one thing I wanted to reiterate again is reversing entries. If we recorded a reversing entry at year end, we would have done so by reversing this as soon as we opened the books in fiscal 2024. If we did that, then we would simply have to debit interest expense for the $9,000 because we would have reversed $3,000 of interest, and we would reverse the payable of $3,000. So keep that in mind. And again, as always with reversing entries, to get comfortable with them, rework that and do it to make yourself comfortable with the process, increasingly comfortable with the process of reversing entries. So they are pretty popular. All right, thank you for your attention. Have a wonderful day.